Hello, my name is Colin and I'm a Senior Consultant Actuary at a pensions consultancy firm called Isio. We're delivering this webinar on behalf of SPPA, who are the administrators to the NHS Scotland pension scheme. This session follows on from the remedy material on the SPPA website, which you may have already seen. In this session, we focus on the pensions tax annual allowance impact of the remedy. You are watching this seminar because you've received or expect to receive a remedial pension savings statement, or RPSS for short, which covers tax years from 2015-16 right through to 23-24. Hopefully, this session can help you to understand what the statement is telling you and what you need to do. If you have received an RPSS, then you need to action. This is separate and unaffected by your MacLeod remedy choice at retirement. What we will cover in today's session is all generic, of course. We will go through a case study to illustrate how the effect of the 2015 remedy might play out on the majority of annual allowance tax charges. But of course, it should all be taken as guidance and not financial advice. In terms of the topics that we'll cover, first, we'll look at the UK pensions tax regime. So as part of the UK regime, we will discuss the annual allowance, namely what it is and how it is calculated. It's worthwhile going through this, as although many people listening may have had tax charges in the past, this may have been some time ago, and there may be others that will have an annual allowance tax charge for the first time. We will then pause on talking about pensions tax and turn our attention to the MacLeod remedy, who it impacts, how it impacts them, and when. We will then combine the two aspects together, focusing on the impact of the MacLeod remedy on historic annual allowance tax charges. As this is a recorded session, there won't be any questions during or at the end of this presentation. Before we start talking about the 2015 remedy, it's useful to run through some of the background on the annual allowance. Currently, we have quite a generous system of pensions tax relief in the UK. It works on the basis of exempt tax. That is, contributions to a pension scheme are tax-free, and in the scheme that you are a member of, defined benefit schemes, you are building up a benefit tax-free. The only tax that is payable is at the end when your pension is taxed as income. But even then, there is the opportunity to take 25% of the total value of the benefits you receive as a tax-free lump sum. As the system is quite generous, the government obviously has to have a method of controlling the amount of tax relief available, and it does this through the annual allowance. Note that previously there was a limit on the amount of retirement benefits an individual could build up over their whole life, and this was tested at retirement and was otherwise known as the lifetime allowance. However, following the March 2023 budget, this limit has now been removed. So what is the annual allowance? The annual allowance is tested each year, and it's the maximum amount of retirement benefit that you can build up and receive full tax relief. We use the term growth on the slide because of the nature of the pension schemes that you're members of, which are defined benefit schemes, where your benefit is building up or growing each year. Retirement savings covers both your pension and, if you were in the 95 scheme, your lump sum. Note the asterisk, and this means the annual allowance is measured over a pension input period, or PIP. This used to make the calculation even more complex, as it could have been any period over 12 months. But in the tax year 2015-16, PIPs for all pension schemes were aligned with the tax year. So all PIPs now run from 6th of April to the 5th of April the following year. This is quite a busy slide, but it highlights the changes in the annual allowance from 2015-16 to the recent March 2023 budget announcements. In general, the standard annual allowance for most people is £40,000. Since 2016-17, we have had a tapered annual allowance for higher earners, which can be as low as £4,000 or £10,000 for some, depending on the year. You will see that there is an odd year in 2015-16, which is the transitional year when the pension input period was aligned with the tax year. For the NHS Scotland pension schemes, this split PIP, as we often refer to it, ran from 1st of April 2015 to the 8th of July 2015, and then 9th of July 2015 to 5th of April 2016. From 2020-21, the tapered annual allowance changed. It now affects fewer people as the limits increased significantly, but the minimum annual allowance fell to £4,000 for the highest earners. We will come back to this in a later slide. There were further changes which took effect from 6th of April 2023. The annual allowance increased to £60,000 for the 2023-24 tax year onwards, and the minimum tapered annual allowance rose back up to £10,000. So the annual allowance limits the amount of pension savings you can build up each year tax-free. Again, we use the term growth because of the nature of the schemes that you're members of, which are defined benefit schemes. If you exceed the annual allowance, there is a tax charge on the excess at your marginal rate of income tax. There is only one way to reduce or remove an annual allowance tax charge, and that is through carry forward of unused annual allowance from the 3 previous tax years. And we'll discuss this more in a later slide. Before we look at how the annual allowance is tested, a few important words about responsibilities. The annual allowance is a personal income tax charge, and therefore ultimate responsibility to account for it lies with you, the individual member. It must usually be accounted for through a self-assessment tax return, although there is a distinct process around the 2015 remedy, which we'll cover at length today. But it is a complex process, so there are statutory responsibilities on other parties as well. The employer must provide the scheme with pay and service information. The scheme administrator cannot calculate your benefits in a defined benefit scheme without that information. The administrator has a number of responsibilities. It must calculate the pension input amount. This is the name for the value of the increase in your pension savings over the year that will be tested against the annual allowance. You will see this term referred to in your pension savings statement. So if the pension input amount exceeds the standard annual allowance for a given PIP, the scheme administrator must send you a pension savings statement showing the pension input amount for the current year and the 3 previous tax years. It must also pay the tax charge to HMRC if certain conditions are met and you ask it to. This means that instead of you paying the charge now from net income, it would be deducted from your pension when you retire. We'll come back to explain this more as we go through the case study, but it's otherwise known as scheme pays. So there are basically 2 different types of pension scheme: defined contribution and defined benefit. In a defined contribution scheme, the pension input amount calculation is quite simple. It is simply the total employer and employee contributions paid into the scheme over the PIP. But in the NHS Scotland pension scheme, the pension schemes are defined benefit. This means that you are not paying money into a pot which will grow over time to provide benefits. Rather, you are building up an entitlement to an annual pension. So for final salary schemes, which are the 95 and 2008 sections, this is calculated using a formula based on length of service and pay. For career average schemes, such as the 2015 scheme, you build up pension based on a percentage of how much you earn in each scheme year. So the government is not interested in what is being paid into a defined benefit scheme. The pension input amount is calculated as the increase in the value of the benefits you build up in the scheme over the year and is then tested against the annual allowance. The pension input amount calculation looks at the difference between the pension and lump sum you build up in the scheme at the beginning of the year and the pension lump sum you had built up at the end of the year after allowing for inflation. The difference is the amount of benefit built up in the year in real terms, and a value must then be placed on this to test against the annual allowance. For pension, the factor to do this conversion is 16:1. So in crude terms, you can think of this as a rough life expectancy. Imagine a pension of £1,000 per year paid for 16 years would be worth £16,000. This factor of 16 is a flat factor set by HMRC and used by all schemes for all members of all ages. If you're in the 95 scheme, you are building up pension and lump sum separately. So in this case, the pension input amount to test against annual allowance is 16 times the increase in pension plus the increase in lump sum, noting that the factor of 16 isn't applied to the lump sum as it's only paid once, not annually. So since 2016, there's been an extra complication to the annual allowance for higher earners. If your total income exceeds a certain amount, your annual allowance can be reduced. There is a two-stage test to determine if you are affected. The first test is to add up all your income that is subject to income tax. So as you can see on the slide, this is not just your salary, but all of your income from your employment and also all other income you may receive that income tax is payable on. Property income from properties you own and rent out, investment income, and pension income. This last item is where you are already in receipt of a pension from a pension scheme. This counts as taxable income. If your total income is lower than £200,000, you are not affected by the taper and your annual allowance will be £40,000. If the total is more than £200,000, you must move to the second test, which is called your adjusted income. To test against the adjusted income, you must add up all the same things again, i.e. all your taxable income, and then add in the value of your pension savings. So in the case of a defined benefit scheme, this is 16 times the pensions growth that we were talking about on the previous slide. This is then compared to £240,000. If it is lower than £240,000, then you are unaffected by the taper and you will have the full £40,000 annual allowance. If it exceeds £240,000, then your annual allowance will be reduced, and we'll show you how on the next slide. Note that the limits on the slide applied from 2020-21 to 2022-23. The note below the table explains what these limits were for 2016-17 to 2019-20. This diagram makes it a bit clearer how the taper works. While adjusted income is under £240,000, your annual allowance is £40,000. And then it comes down in a straight line. You lose £1 of your annual allowance for every £2 of adjusted income above £240,000. So that for anyone with adjusted income of £312,000 or more, their annual allowance is £4,000. Again, note different limits for different years outside of 2020-21 to 22-23. Note that from 2023-24 onwards, the adjusted income limit is £260,000 and the minimum annual allowance had increased back up to £10,000. We have mentioned carry forward a few times already, so let's now look at how it works. And it works in a very specific way. If you exceed the annual allowance in the current tax year, so on the slide we are looking at 22-23, then you can look back to the 3 previous tax years to see whether there is any unused annual allowance to carry forward. You start from the earliest year and work forwards. And the reason for that, of course, is that as you move from one tax year to the next, the earliest year drops out of the calculation. Where your pension input amounts are lower than the annual allowance in each of the 3 previous years, you can just see whether there is enough carry forward in total to offset the current year's excess. But in a situation such as that on the slide, you need to remember what happened in previous years as well. If this person doesn't look any further back than 2019-20, they may underestimate their carry forward balance because they may think some or all of the unused annual allowance from 2019-20 was used up in 2020-21. But of course, in 2020-21, it was possible to look back to 2017-18. So it is necessary to look back to those previous 2 years to see if there was unused annual allowance which was used up by the 2020-21 excess, leaving the 2019-20 unused annual allowance still available. It is complicated, but the HMRC remedy tool for the remedy pensions tax purpose will essentially do this for you because you need to enter figures going all the way back to 2010-11. This slide shows how the NHS Scotland pension schemes have developed over time, so you can see which one you are likely to be in if you are not sure. First, there was the 95 scheme, which is a final salary scheme, and this was closed to new entrants in 2008, and new joiners instead joined the 2008 scheme. In 2011, there was an independent review into public service pension schemes over concerns that they were being too costly for the taxpayer. The outcome of the review was that all the final salary schemes across the public service pensions industry were to be closed and care schemes be introduced instead from 1st of April 2015. As well as new joiners going into the 2015 scheme, anyone who joined the NHS Scotland pension schemes after 31st of March 2012 were immediately moved over to the 2015 scheme from 1st of April 2015. Transitional protections were put in place for those closest to retirement, and they were allowed to remain in their final salary scheme or move into the 2015 scheme at a later date. A lot of individuals have therefore ended up with both a final salary pension, either in the 95-2008 sections or both, and a care pension in the 2015 scheme. For these people, although no more service can be added to the final salary calculation, they are still linked to your salary, which can still go up over time. So in a year where your pay goes up by more than inflation for the annual allowance calculation, you will get a real terms growth in your final salary pension, which contributes towards your overall pension input amount for that year. And indeed, it is often a promotion or large pay rise which causes an individual to breach the annual allowance in a given year because of the impact on their legacy pension rather than on the 2015 scheme. However, there was Victoria MacLeod in the judicial pension scheme who took the government to court over the transitional protections that were put in place and won. Likewise, there was Sargent in the firefighters pension scheme who did the same but lost. The parties that lost appealed the decision, and given the cases were so similar, the High Court ruled on them together, and the result was a ruling in favour of MacLeod Sargent that the transitional protections put in place were deemed to be discriminatory on the basis of age. The government was then tasked with removing the age discrimination from all the public service pension schemes, and it did this through what is commonly known as the MacLeod Remedy. For more information on the remedy itself, you can visit the SPPA NHS Remedy Hub at the website address in the last bullet point. So this slide provides a visual representation of how members affected by the MacLeod Remedy. There are three types of member as at 31st of March 2012, depending on how close they were to retirement, and the remedy impacts them differently. For those that were more than 14 years from retirement at 31st of March 2012, these members were unprotected in that they didn't have any transitional protections and were moved into the 2015 scheme on 1st of April 2015. Fully protected members were within 10 years from retirement at 31st of March 2012, and they were allowed to remain in their final salary scheme until retirement. Taper protected members were between 10 and 14 years from retirement, and they were moved over to the 2015 scheme at some point between 1st of April 2015 and 31st of March 2022. Now, to remove this discrimination between these groups of member, the remedy was implemented in two phases. The first was to move everybody into the same pension scheme. As a commitment to the initial review of the costs of the public service pension schemes, everybody, regardless of previous protections, were moved into the 2015 scheme from 1st of April 2022, if not already in it. The second phase was to do with the discrimination from the period 1st of April 2015 to 31st of March 2022, or what we call the remedy period. Legally, members' benefits were rolled back into the legacy scheme, either the 95 scheme or the 2008 scheme. However, it was acknowledged that some members may have been better off in the 2015 scheme, and so at retirement, members can choose if the 2015 scheme benefits for this period instead. In terms of annual allowance tax charges, some people have had their position based on their legacy scheme, while others on the 2015 scheme. By rolling back everyone's benefits into their legacy scheme and recalculating the pension input amounts will mean that everyone will be paying tax on a more equal basis. For unprotected members, they will have 7 years of revised annual allowance tax charges to calculate. Fully protected members' benefits are already in their legacy scheme, and so they won't receive an RPSS and don't need to revisit any historic tax charges. Taper protected members, like the unprotected members, will have up to 7 years worth of tax charges to revisit. Now let's look at how this rollback of benefits interacts with the annual allowance calculations. I will first talk about this one-off exercise to correct annual allowance tax charges over the next 3 slides in these concepts. We'll consider the information you need to gather and where to get it, what you do with this information, and ultimately when you need to have it done by. On 1st of October 2023, the second phase of the remedy was enacted, meaning that your benefits for the remedy period were rolled back into your legacy scheme. To do this, the scheme administrator set up a legacy record for you, and by the regulations, if there has been a benefit change to your benefits for a given tax year, the scheme administrator needs to recalculate your pension input amount for that relevant year and issue you with a remedial pension savings statement. With the information in your RPSS, you have to gather other information such as your taxable income and details of any previous tax charges, more on this in a second, and complete the HMRC calculator that has been set up for this particular exercise. From the HMRC calculator, you will get your revised annual allowance tax position, and you need to decide how to settle any additional tax charges, if applicable. If you had a tax charge for the 23-24 tax year, this needs to be accounted for through the usual route of self-assessment. Note that the 22-23 tax year isn't necessarily in the remedy period, but as it's been delayed from last year, it can be completed through the HMRC calculator, and self-assessment doesn't need to be amended for that year. In terms of the information that you need to gather, you need the updated pension input amounts for the NHS Scotland pension scheme from your RPSS from SPPA, as well as any pension input amounts from other schemes, if you built up benefits in any other pension arrangements. An important point to note is that the annual allowance is for you as an individual, not per pension scheme that you've grown benefits in. To test against the annual allowance, you need to add up the pension input amounts for all the pension arrangements that you've grown benefits in that particular tax year. If you previously had any tax charges from 2015-16 to 22-23, what was the charge and how was it paid for? You can find this information from either your own records, perhaps emails from SPPA, or if you have an online tax account with HMRC. Historic taxable income for the period 2015-16 to 2022-23, and you can get this from your P60s and your own records of other taxable income you've received, such as RED investment income, and indeed any pension benefits that you're currently drawing. We discussed on the previous slide that your benefits were rolled back into your legacy scheme on 1st of October 2023, and from early October 2024, RPSSs are being sent out to the relevant population. We are aware that some people have not received their RPSS yet, and these should be being sent out in the coming weeks, staggered over the summer, with more complex cases coming later. Using your RPSS and the other information set out on the previous page, you need to complete the HMRC calculator by the later of 31st of January 2025, or 3 months from when you received your RPSS. Although the initial deadline of 31st of January 2025 is now passed, HMRC have said that they will not automatically issue any penalties for missing a deadline if the member is seen to be actively trying to sort out the revised pensions tax position. The deadline for informing the scheme if you intend to use Scheme Pays is 6th of July 2025. I will cover more detail about Scheme Pays in our case study later. Before we look at the actual RPSS itself, we do get a lot of questions from members asking why their pension input amount has moved in a certain direction, and it will vary by age depending on the individual circumstances. The build-up rate in 2015 scheme is approximately 50/4ths, while in the 95 scheme the build-up rate is 80ths, and again lower in the 2008 scheme as well at 60ths. Therefore, if rolling back to the 95 or 2008 scheme, it is likely the pension input amount will go down due to the impact of the change in build-up rate, resulting in possible tax refunds. However, the timing and size of any salary increases also have an impact on the direction of revised pension input amounts. In a final salary scheme, a large increase in pay combined with more pensionable service can result in an increased pension input amount, as an increase in salary in a care scheme only impacts that year and subsequent years, where with a final salary scheme, past benefits are also linked with any big salary increases. Conversely, if salary increases have been below inflation, then rolling back into a final salary scheme may decrease the pension input amount, as the 2015 scheme care benefits are increased in line with inflation plus 1.5%. By the nature of the calculations, the difference in the retirement ages have no impact, as the factor of 16 is applied to any increase in pension benefits over the year. Whether you have a refund, increase, or new tax charge greatly depends on your individual circumstances, though we broadly expect most people to receive refunds or not have any additional charges. If you are unsure if you have received a remedial pension savings statement, then you would have received it in the post and it would look like this. The first table is the pension input amounts for your legacy scheme. The updated pension input amounts for the 2015-16 to 21-22 years, which represent your benefits for that period being rolled back from the 2015 scheme into your legacy scheme. This will also be the first time that you receive the 22-23 and 23-24 pension input amount figures. The second table shows the pension input amounts in the 2015 scheme. As benefits for the remedy period have been rolled back into the legacy scheme, this means that there aren't any pension input amounts for the 2015 scheme until the 22-23 tax year. The total pension input amount to test against annual allowance is the pension input amount from the legacy scheme plus the pension input amount from the 2015 scheme and any other pension arrangements benefits that you've built up. The annual allowance is an allowance for you as an individual rather than for each pension arrangement that you're building up benefits. From the March 2023 budget changes, 23-24 is the first year that a negative growth in the legacy scheme, say, can now offset the positive growth in the care scheme. To summarise, the RPSS gives you all the updated information you need about your pension build-up in the NHS Scotland pension scheme. This will have the pension input amounts from the period 2015-16 to 22-23. There is a guide to your RPSS, and that can be found at the NHS Scotland Pensions Remedy Hub. As stated previously, you will need to add the pension input amounts for the legacy scheme and the 2015 scheme together. If you built up benefits in another pension arrangement, you'll need to add the pension input amounts for these arrangements to your NHS Scotland pension scheme pension input amounts. HMRC have released a special calculator to submit your revised information for the PIPs from 2015-16 through to 22-23. If you have incurred a tax charge for 23-24, this should be reported through self-assessment and not through the HMRC calculator, which will only cover the period from 2015-16 through to 22-23. So HMRC have provided a tool in order to calculate your revised pensions tax position for this one-off exercise, and must be used to submit your results to HMRC unless you are using an agent to do it on your behalf. The first bullet point gives the address for the calculator, which the formal name is Calculate Your Public Service Pension Adjustment, or we refer to as the HMRC tool or HMRC calculator. The main inputs required for the tool are the pension input amounts for the period 2010 to 2011, all the way up to 2014-2015, and these can be found in your RPSS and is used to ensure the correct carry forward position is used for 2015-16. For each tax year from 2015-16 to 22-23, you will need the pension input amounts from your RPSS. If you paid a tax charge in the past, what was the amount of the tax charge and how was it paid? From 2016-17, you need to know your threshold income, basically your taxable income from all sources. And if you're above the threshold income limit, then you will need your revised adjusted income, which in most cases is your threshold income plus your pension input amount. Everyone will need to have their taxable income for each tax year, as this is used to calculate your marginal rate of tax. Don't worry if you're unsure how to do any of these calculations, as the HMRC tool will do a lot of the work for you. You just need to enter the required information into the HMRC tool and it will do the work, calculating the carry forward, tapered annual allowance and your revised tax position for you. In order to submit your results to HMRC, you have to use the HMRC tool or have an agent do it on your behalf. In order to submit your results through the tool, you need to have a government gateway username and password. However, you can still use the tool without logging in so that you can have a look at the types of questions it asks and do a dry run without having to submit any results. If you don't have a government gateway account, you can register for one at the website address on screen. By signing in with your government gateway, you can save your progress and return to it later, as it may take some time to complete. The tool does have a triage stage at the beginning designed to prevent members who do not need to complete tool from doing so. For example, if the member had a previous tax charge and their pension input amounts have gone down, then it's impossible for them to either receive a refund or pay extra tax, as they would be triaged out of the tool. If you have a tax charge to pay, you can decide whether to pay by cash or Scheme Pays. If you want to use Scheme Pays, then you can select Scheme Pays directly through the tool without having to contact the administrator. The remedy period and 22-23 tax years are split into out-of-scope and in-scope tax years. The earliest 4 years, 2015-16 to 2018-19, are the out-of-scope tax years. If your revised pensions tax position shows that you had underpaid your tax for these years, you do not need to pay anything and no action is required for these years. If it was found that you had overpaid your tax, however, you can claim compensation. The form of this compensation is covered in the next slide. The later years are referred to as in-scope tax years, and the main difference with these years is if it is found that you had underpaid your tax, you are required to meet this additional charge. You will have a choice of whether you pay the additional charge by Scheme Pays or by cash. Similar to out-of-scope tax years, if it is found that you had overpaid your tax, then you can claim a refund. Again, this is covered in a later slide, but the difference between compensation and refund is just HMRC semantics. They're essentially the same thing. For out-of-scope tax years, if there is a refund, the form that the refund takes is the same as the form used to pay the initial charge. If you previously paid by cash, then you will receive compensation directly from the scheme. If paid by Scheme Pays, then the Scheme Pays debit will be adjusted down or removed as appropriate. The process for refunds for in-scope tax years is similar to the out-of-scope tax years, with the refund taking the form as it was initially paid. The main difference is that if someone paid cash, then the money would be refunded by HMRC, whereas for out-of-scope tax years, you'd receive the money from the scheme. Like the out-of-scope tax years, if you had paid the initial tax charge by Scheme Pays, then the Scheme Pays debit will be adjusted down or removed as appropriate. Now to take you through a case study which will hopefully bring everything we've talked about to life. We have Julie, who was previously in the 95 scheme and had tapered protection, meaning that she was moved to the 2015 scheme on 1st of April 2016. Column A shows Julie's initial pension input amounts, i.e. before her benefits have been rolled back into her legacy scheme. Column B shows the carry forward from the 3 previous tax years, and column C shows the standard annual allowance, which is the same for each of these tax years. The last column shows the taxable excess, which is the excess of the pension input amount above the annual allowance after taking into account any carry forward. Please note that the taxable excess is not the tax charge, but we'll come back to this later. If we look at the 2016-17 tax year, we see that Julie had a pension input amount of £65,000, a standard annual allowance of £40,000, and unused annual allowance of £45,000 from the 3 previous tax years to carry forward. And we can see that although the pension input amount is above the annual allowance, there is enough carry forward to offset any excess, and so Julie does not have any tax charges for this year. Going into 2017-18, we can see that the carry forward has reduced because some of it was used up in the previous tax year. Again, there is no charge this year, as even though Julie's pension input amount is above the annual allowance, there is still enough carry forward to offset any excess. Julie's pension input amount is £2,000 above the annual allowance of £40,000, and so the carry forward to take into 2018-19 decreases by £2,000. In the 2018-19 year, Julie has a spike in her pension input amount, possibly as a result of a promotion or large salary increase, and there is not enough annual allowance and carry forward to offset the pension input amount, leaving a taxable excess of £38,000. Going into 2019-20, Julie has again breached the annual allowance, with her pension input amount being £33,000 above £40,000, with no offset from carry forward, as this was all used up in the previous tax year. This highlights the issue that once you do receive a tax charge, you are more likely to receive one the next year, as there is no unused annual allowance to carry forward. In 2020-21, there is no taxable excess, as the pension input amount is below the annual allowance. As such, there is £6,000 of unused annual allowance to carry forward into the 21-22 tax year. Again, Julie is below the annual allowance in 21-22, and the £15,000 of unused annual allowance is added to the carry forward for 22-23, increasing it to £21,000. In the 2022-23 tax year, we see that although Julie breaches the annual allowance, she has just enough carry forward to offset the pension input amount. Now, we looked at Julie's tax position post-rollback, when all her 2015 scheme benefits in the remedy period are now rolled back into the 95 scheme. I appreciate there are a lot of figures on this slide, but we'll go through it slowly. So the first 4 columns of the table on the left-hand side is just the table from the previous slide. The next 4 columns represent the same figures, but based on Julie's benefits being in the 95 scheme for the remedy period. Column D represents the revised pension input amounts that she would have received from her RPSS, and you'll notice that they have decreased for each year, the main reason being that the build-up rate in the 95 scheme is lower than in the 2015 scheme. Column E reflects the carry forward, which will have increased due to lower pension input amounts, meaning there is more unused annual allowance to carry forward. With lower pension input amounts and more carry forward, Julie is likely to have reduced the revised pensions tax position, leading to possible refunds. Note that the standard annual allowance is unchanged at £40,000. In the 2016-17 and 2017-18 tax years, the pension inputs have gone down and carry forward increased for 2017-18, so there is still no taxable excesses. In the 2018-19 tax year, the pension input amount has decreased from 96,000 to 75,840. Combined with more carry forward due to lower pension input amounts in previous years, the taxable excess of 38,000 has now been removed completely. Similarly, in the 2019-20 tax year, now with some carry forward in play, the lower pension input amount means that the taxable excess has reduced. For the 2020-21 tax year, Julie is still under the annual allowance, but now has more unused carry forward to take into the 21-22 tax year. In the 21-22 tax year, due to the decrease in Julie's pension amount, she's still under the annual allowance, and she has more carry forward to take into 2022-23. Note that the pension input amount for the 22-23 tax year does not change as it is not in the remedy period, and so benefits have not been rolled back, but Julie has more carry forward, meaning that less will be used up to offset the taxable excess, and therefore have more carry forward to take into the 23-24 tax year. Before rollback, Julie had taxable excesses in the 2018-19 and 2019-20 tax years. However, as a result of rollback, the taxable excess in 2018-19 has fallen away altogether, and the 2019-20 taxable excess has reduced. This means that Julie is in line for a refund for both years. How Julie will receive her refund will depend on whether the tax year is in scope or out of scope, and if she paid by cash or scheme pays. A note on the tapered annual allowance. So if you're subject to the tapered annual allowance, then this will also have changed after rollback. Consider Julie's pension input amount for 2018-19, which fell from £96,000 to £75,840 following rollback. If Julie's threshold income, which is our taxable earnings after adjusting for pensions contributions, for 2018-19 had been £115,000, then her adjusted income would have been £211,000, and she would have been subject to a tapered annual allowance of £10,000. Following rollback, her threshold income is unchanged, no change to taxable earnings or to pensions contributions, which were the same in the NHS 95 and the 2015 sections. But her adjusted income has reduced to £190,840. This means her tapered annual allowance for 2018-19 is now £19,580. So this is a win-win as a lower pension input amount and higher annual allowance against which it can be assessed. For the out-of-scope tax years, we saw earlier that Julie initially had a taxable excess of £38,000, which with a marginal tax rate of 40% meant she had a tax charge of £15,200. Now post-rollback, Julie has no taxable excess, meaning she has overpaid her tax by £15,200. Julie will receive compensation. How she receives this compensation depends on how she paid the initial tax charge. If the reverse was true, if Julie had underpaid her tax, then as this is an out-of-scope tax year, Julie would not have to pay the extra charge. For the in-scope tax years, we saw Julie initially had a taxable excess in the 1920 tax year. This initial taxable excess was £33,000, and with a marginal tax rate of 40%, the tax charge was £13,200. Following rollback, the taxable excess and tax charge decreased, meaning that Julie had overpaid by £7,984. When Julie completes the HMRC tool and submits the results, it will inform HMRC of Julie's revised tax position. The form of the refund depends on how the initial tax charge was paid. Julie now needs to decide whether to pay these increased tax charges. If the opposite had happened and Julie had underpaid her tax, then she would need to decide whether to pay the increased tax charge using scheme pays or directly with cash. Note that the HMRC tool allows you to select to pay your tax charge by scheme pays. We have assumed here that Julie used scheme pays in each of the years where she had an excess. This means that the scheme paid the tax charges on her behalf and calculated the reduction to her benefits, which will stay on her record and be applied at retirement. For both tax years, she is owed a refund, and for both in-scope and out-of-scope tax years, the refund will be paid by HMRC to the scheme. The scheme will therefore recalculate her scheme pays adjustment. Julie does not get to make the choice again. She cannot, for example, now choose to pay her reduced 2019-20 tax charge directly to HMRC. Members with benefits in both the Legacy Scheme and the 2015 scheme were usually given the choice of which scheme to take their scheme pays adjustment from. So for purpose of this example, we have chosen one from each scheme. For 2018-19, we've assumed that Julie originally chose to have a scheme pays debit applied to her 95 benefits. So you can see the debit is comprised of a reduction to both her pension and lump sum. This is how scheme pays is applied in the 95 scheme. Her rollback position was a full refund of the tax charge for that year. So this one is simple. The scheme pays debit will simply be wiped off her record. For 2019-20, we have assumed that Julie originally chose to have a scheme pays debit applied to her 2015 pension. This is just pension, no lump sum. So following rollback, Julie was no longer in the 2015 scheme in 2019-20, so she cannot have her debit applied to that scheme. The updated reduced amount must be taken from the 95 scheme. Therefore, a debit based on a lower tax charge is calculated using the 95 scheme factors, which includes a debit for the lump sum. This change will automatically happen once results are submitted via the HMRC tool, or if an agent does it on her behalf. Now, just to highlight some key points regarding the 2022-23 and 2023-24 tax years. Although the 2022-23 tax year is not part of the remedy period, it relies on the remedy period positions being correct for the carry forward of any unused annual allowance. This was the reason that you wouldn't have received a pension savings statement for the 2022-23 tax year last year. Your 22-23 pension input amount is included in your RPSS. If you have a tax charge for 22-23, this is taken care of through the HMRC tool. You should not adjust any self-assessments for 22-23 or the remedy period as it is handled by the HMRC tool. The HMRC tool allows you to select to pay any tax charges using scheme pays. The deadline for 22-23 is the same as the remedy years, in that it is the later of 31st of January 2025 or 3 months from when you received your RPSS. For the 23-24 tax year, your pension input amount for 23-24 should be included in your RPSS. It requires your 22-23 position to be correct. If you have a tax charge for this year, you should report it through the usual approach of self-assessment rather than the HMRC tool. The deadline for self-assessment for the 23-24 tax year was 31st of January 2025, though you can still make a late submission or adjustment up to 12 months after this date. If you don't have your 23-24 pension input amount and you expect to have a tax charge, then you need to submit an estimate. There is a video on the SPPA website that helps determine whether it's likely you will have a tax charge and how to make an estimate if necessary. Once you receive your pension input amount for 23-24, then you can make an adjustment to your self-assessment. Following the March 2023 budget announcement, the annual allowance for 23-24 and subsequent years was increased to £60,000. This is also the first year that a negative pension input amount in one scheme can be used to offset the pension input amount in another. Previously, the pension input amount was bottomed out at zero. To summarise and give you some actions to take away, for the 2015-16 to 2022-23 tax years, do read and understand your RPSS and seek additional resources if anything is unclear. Gather any other information such as your taxable income, details of any previous tax charges, and pension amounts from any other pension arrangements you paid during this period. Enter your information in the HMRC tool and submit using your Government Gateway username and password. If you are owed a refund, then it will take the form that you used to pay the initial tax charge. If you have more tax to pay, then you will need to decide whether to pay directly or use Scheme Pays. For the 2023-24 tax year, this isn't to be reported through the HMRC tool and instead is done through the usual route of self-assessment. The pension input amount for 2023-24 is included in your RPSS. Similarly, you will need to gather any additional information in terms of taxable income or pension input amounts of other pension arrangements if appropriate. Again, you need to decide if paying any tax charges directly or use Scheme Pays. In terms of other benefits, for added pension, if you paid extra to buy additional pension in the 2015 scheme during the remedy period, this will have been rolled back into your legacy scheme. Your rolled back pension input amount in your RPSS will reflect this. If you made additional payments to reduce your normal pension age, you will be refunded with these contributions. There are still some details to be finalised on this, but more information is found on the SPPA website. For pension sharing on divorce, any benefits that have been subject to a pension sharing order since 1st of April 2015 will need to be recalculated. If you transferred in service from another pension arrangement which is impacted by the MacLeod remedy, this will need to be recalculated to reflect the rollback position. SPPA will carry out the necessary calculations and will be reflected in your annual benefit statement and RPSS. A contingent decision in the spirit of remedy would be, if I hadn't been moved to the 2015 scheme, I would have done X instead of Y. So if you believe you would have taken different actions had you remained in your legacy scheme, then there is a process where you can apply for a retrospective change to be made to your record. This is in keeping with the aim of remedy, which is to put you in a position that you would have been had the age discrimination not happened. An example of a contingent decision affecting your pensions tax position is if you subsequently buy back service in your legacy scheme when you'd previously opted out of the 2015 scheme. The pension input amounts for the impacted years would need to be recalculated, as well as the pensions tax position for the subsequent years that rely on the carry forward from those affected years. Information on how to apply for a contingent decision is available on the SPPA website. So thank you for listening to me today about the remedy impact on the annual allowance. This slide has links to various sources of further information, including the NHS Remedy Hub, the impacts of remedy on annual allowance, the reimbursement scheme, which is to claim for professional services to help you complete the HMRC calculator, a link to the HMRC calculator itself, and the rest of the links are to HMRC materials for business as usual years. If you have any questions regarding the webinar or for any further support, please don't hesitate to contact us using the email addresses on the screen.